I'm here with David Buckham, CEO of Monocle Solutions. Now, David, you just wrapped up a panel discussion with Ari Rotenbach, CEO of Absa Group, and Margaret Ninaba, the COO of Standard Bank. So quite an interesting panel discussion, sketching out the landscape of where South Africa and our financial services industry sits at the moment. What were your key takeaways from the discussion?
Well, first of all, I must say I was very impressed with how positive both of them are in the current economic climate. Both those banks, both Standard Bank and Absa, have performed admirably in these circumstances. Their numbers are phenomenal, and I think they're putting a very positive foot forward, and for good reason. On the other hand, I think also a very strong message came across about some of the geopolitical trends, the challenge with fighting inflation globally, and the problem of South Africa recently being grey listed. So overall, I would say it impressed me that that positive trend came across. The concerns that I have are more geopolitical in nature, and I referred to something which I call the multipolar versus unipolar dynamic, which is this idea of the hegemony of the American dollar and of the American system of conviction and the American moral system, you could say. And there's a danger of the world, or certainly parts of the developing world, turning towards Russia and India, China, alternative to the US dollar, for example, and at the same time, kind of moral implications for that. So that was one of my concerns, and I did stress also that it's not self-evident to me that we will be able to solve the grey listing problem unless some very significant political changes were to occur. So those would be my main takeaways. The one other point, the one major point I want to make is that for the first time now in the fight against inflation, that Jerome Powell has raised interest rates to a point where the nominal rate of the federal funds rate is actually greater than the inflation rate for the first time. And that's what I've always said would be required to rein in inflation. But inflation is in a world where recently there's been a spike in the equity markets, especially the tech stocks, and also US unemployment is at almost all-time low. So there is a greater danger that we need to be aware of, that there's a systemic risk of prolonged interest rate cycle, prolonged inflation rate cycle, which is not idiosyncratic, as is sometimes argued in the case of SVB, that is going to leave a number of banks with negative returns on their bond portfolios. So ironically, in a world in which there was too much money printed, that money went into bank accounts, and those bank accounts you have to balance your balance sheet in a bank. The money went into government bonds at super low rates. Rates have come up to fight inflation, and there's hundreds of billions of dollars of unrealized losses. So, for example, Bank of America, they estimate $100 billion unrealized loss on their bond portfolio, which they intend to hold to maturity. But if inflation were to be sustained, and if the interest rates have to be sustained, it's going to be a balancing act. How does that impact us in South Africa in a closed loop system? Less so in the short run. I would say our short-term risks remain being cast out of the global financial system through grey listing. But the health of the South African banking system is very strong, as is the regulatory system.
Yeah. And David, your sense of the strength of the American economy and the American banking sector, what is your outlook? What have you seen?
So it is Guy, one of those really fascinating times from an economic kind of perspective to look at the American system and notice that America has not gone into recession. The job market is still very hot. There's 1.7 vacancies for every unemployed American. You have got the stock markets have gone up again, which I would not have predicted. Very much driven by an AI narrative. So they've kind of jumped from the crypto narrative to the AI narrative. This is the new hot topic. And then you've got the federal funds rate at a high point for the last 40 years, with the prediction that they're going to raise still further to continue to rein in inflation. And it was during the early 1980s, federal funds rate got ahead of the nominal rate of inflation a couple of times before they actually beat inflation. So it's my view that the American economy is still too resilient for them to stop raising rates, and you're going to continue to see inflation being double or even triple what they want it to be, which is in a range of 0 to 2%, which means that we're going to have what I would say is a continued bumpy ride. I would definitely say that the stock markets are overvalued, and you've still got the 2-year yield at the government yield at say 4.9%, and then at the same time you've got hundreds of billions of dollars of unrealized losses on the 4 major banks. And then remember now that you've got thousands of regional banks that constitute 80% of commercial property lending that have not accounted for the mark-to-market value of bonds on their balance sheet, that might too experience liquidity crunches like SVB. So the American regulators might have to step in and guarantee all deposits, which would create enormous moral hazard. So I'm not painting a very pretty picture. On the other hand, the American economy is very strong given the circumstances.